Good afternoon, everyone. Welcome to the 2026 Annual Regulatory Highlights webinar. I'm Toni White, Director of Outreach and Education, and I'll be your host for today's event. Before we begin, I'd like to review a few housekeeping items. First, all participant microphones will remain muted throughout the webinar. Second, today's webinar is being recorded and will undergo a review process to ensure it meets quality and accessibility standards before it's published on Maryland's Department of Labor YouTube page. Our outreach associate, Cynthia, is assisting behind the scenes today. If you experience any technical issues during the webinar, please use the chat feature to communicate with her directly. We will also reserve time at the end of the presentation to address submitted questions if time permits. If we are unable to answer your questions during today's webinar, our team of subject matter experts will follow up with you directly in the coming days. And finally, we've included several helpful resources in the handouts section for your review and use. At this time, it is my pleasure to introduce our Commissioner, Toni Salazar, for opening remarks. Commissioner Salazar?
Thank you, Toni. Good afternoon. I'm Toni Salazar, Maryland's Commissioner of Financial Regulation. I want to welcome each of you to the Maryland Office of Financial Regulation's 2026 Regulatory Highlights webinar. Each year, the office hosts this session to provide a broad overview of our activities over the past year. The session is primarily intended for licensees and entities subject to the office's jurisdiction, though I know that others with an interest in financial regulation in Maryland will also find this session informative as we discuss topical issues in the financial services field, including those that we see coming in the next year. We'll provide comments on legislation and regulations, as well as some top-level feedback from our examination activities. The field of financial services has been in flux over the past year. It has been strongly impacted by changes at the federal level, changes in regulatory policy, in legal personnel and approaches, as well as by legal developments at both the state and federal levels, and of course, by the acceleration of technological changes. At the federal level, the theme has been the change of direction, personnel, and retrenchment. Federal banking and credit union regulators have new leadership at many levels, and the new leaders have moved swiftly to change their regulatory approach. In the case of the Office of the Comptroller of the Currency, they've actually moved to preempt states' authority. On the other end of the spectrum, the Consumer Financial Protection Bureau has significantly curtailed its activities and headcount. Faced with these circumstances, our office has worked closely with other sister state regulatory agencies, primarily through the Conference of State Bank Supervisors, to oppose changes that were deemed inappropriate and harmful to consumer and states' rights, and to provide the new federal regulators in Congress with the state's perspective on other changes to ensure that they are workable and that they are right-sized for the institutions that they affect. Notwithstanding the changes at the federal level, I'm proud to say that our office has continued its supervisory, regulatory, and consumer protection efforts. We are the proverbial steady-as-she-goes ship. Not only that, but Maryland's Office of Financial Regulation has been recognized as a leader in financial services regulation. From consumer protection, where we fought for and obtained strong consumer protections from abuse in earned wage access and crypto ATM areas, to using its regulatory tools to promote the expansion of banking services in the state of Maryland by proposing and obtaining enhancements to the groundbreaking Access to Banking Act. We've also been fostering innovation through the proposal and passage of one of the first state stablecoin enabling systems. OFR has been active at the forefront of financial service regulatory debates, trends, and innovations. Following me, the members of OFR's leadership team will discuss these top-level issues as well as other topics of interest relating to our supervisory and enforcement activities over the last year. I hope that you'll find this presentation to be enlightening, and I want to thank you all again for being here.
Hello, I'm Amy Hennon, the Assistant Commissioner for Policy and Engagement, as well as the Maryland Student Loan Ombudsman. Today we're going to touch on the 2026 legislative portfolio for OFR, some regulatory updates, some critical updates for student loan borrowers, and then finally, OFR's ongoing outreach efforts. The new laws in OFR's 2026 legislative portfolio fall into four primary areas. First, under financial regulation and innovation, we have the Maryland Community Investment Venture Fund, House Bill 259 and Senate Bill 43. This departmental bill alters provisions for the Venture Fund, extending the Commissioner's investment matching authority to June 30, 2030. The new law also provides assessment offset credits for banks and credit unions establishing Maryland Opportunity Accounts. Deputy Commissioner Mike Sprouse will provide further details on implementation. This law is effective July 1, 2026. The Maryland Stablecoin Act, House Bill 1355 and Senate Bill 662, is a departmental bill that is effective January 1st, 2027. In July of 2025, Congress passed the Guaranteeing Essential National Infrastructure in U.S. Stablecoins, or GENIUS Act, which created federal oversight and standards for payment-related stablecoin operations. The bill also allowed for states to establish regulatory standards, provided they were substantially similar to the federal standards. The Maryland Stablecoin Act provides that OFR is the Maryland stablecoin regulator, while giving the office enough flexibility whether the Clarity Act, which would provide more market structure, passes or not. Deputy Commissioner Mike Sprouse and Assistant Commissioner Sharifa Balagoon will discuss the implementation. House Bill 470 and Senate Bill 376 establish the Digital Asset Task Force, effective July 1st, 2026, to study blockchain technology with a report due by October 2027. Finally, Senate Bill 741 clarifies virtual currency kiosk operators and prohibits ATM services. That bill is also effective October 1. Under consumer protection, Senate Bill 94 modifies the Earned Wage Access Law from last year and eliminates tips and prohibits discrimination and false advertising. This bill is effective October 1. The Vulnerable Adult Banking Protection Act, House Bill 1008, Senate Bill 753, allows institutions to delay disbursements to protect older adults from exploitation, effective October 1. Senate Bill 582 prohibits the mailing of unsolicited checks, effective October 1. Under licensing and portability, Senate Bill 242, as well as House Bill 1120 and Senate Bill 418, facilitate portability for certain categories of licenses for service members, foreign service members, and their spouses. The laws are all effective October 1. House Bill 557 standardizes occupational licensing by excluding certain criminal records from being the sole basis for denial and provides a predetermination review process. The law is effective July 1. Finally, House Bill 38 clarifies the circumstances when an insurance producer mortgage loan originator can be licensed when sponsored by a qualifying institution, effective October 1. Finally, under industry operations, House Bill 1049 streamlines credit union mergers effective October 1. House Bill 1118 excludes payroll processing agents from the definition of money transmission so long as they are not performing any other money transmission, aligning Maryland with 46 other states. This law is effective October 1. Lastly, Senate Bill 784 resolves differences in last year's passive trust licensing exemption bills, effective July 1. OFR's 2026 regulatory initiatives build on 2025 legislation. Earned Wage Access, or EWA, reporting regulations were proposed on April 3, 2026, followed by an advisory on May 5, 2026, clarifying reporting requirements. For virtual currency kiosk operators, final regulations became effective March 30, 2026, establishing registration protocols, fee refunds, fraud prevention, and annual reporting. As the Student Loan Ombudsman, I want to highlight the impacts of the One Big Beautiful Bill Act, or OB3. New borrowers after July 1 will face new federal loan limits and must use the Repayment Assistance Plan, or RAP. The new lower loan limits will significantly impact graduate programs. Current Parent Plus borrowers must have applied to consolidate by April 1 to access future income-driven repayment options. Notably, new Parent Plus loans taken out after July 1 will not be eligible for public service loan forgiveness. This includes borrowers who have old and new Parent Plus loans. We are conducting outreach via advisories and webinars to ensure everyone is informed. Finally, our outreach continues with weekly mailings of the Mortgage Late Don't Wait flyer to borrowers facing foreclosure, as well as collaborative webinars with legal services and housing counselors to help borrowers understand their rights and obligations. We also have a mortgagee fact sheet forthcoming to provide further guidance. And now I'll turn it over to my colleague, Assistant Commissioner Sharifa Balagoon.
Good afternoon, everyone. I am Sharifa Balagoon, Assistant Commissioner of Innovation at the Office of Financial Regulation. Today, I will briefly focus on two main areas. First, our examination and supervisory priorities relating to money transmission activity, and second, OFR's broader innovation and modernization efforts. Given our time constraints, my remarks will focus primarily on high-level themes, supervisory priorities, and emerging issues. I have included additional compliance details and operational considerations throughout the presentation materials for you to reference following the webinar. Starting with money transmission, OFR continues to see significant evolution in products, technologies, and delivery models across the payment space. While innovation continues to reshape the industry, our core supervisory expectations remain grounded in safety, soundness, consumer protection, and strict compliance with applicable state and federal requirements. From an examination perspective, our team is currently focusing on 3 primary compliance areas. The first is AML and BSA compliance under federal law. As business models and transaction activities become more complex, it is critical that licensees maintain effective anti-money laundering programs that are appropriately tailored to their specific risk profile. This includes critical functions such as customer due diligence, suspicious activity and transaction monitoring controls, independent testing, and overall program governance. Furthermore, licensees and authorized delegates must file all reports required under the Bank Secrecy Act, including CTRs and SARs, in a timely and accurate manner. Our second priority is ensuring licensees meet baseline financial requirements. This includes compliance with tangible net worth requirements, maintaining appropriate surety bond coverage, and ensuring that permissible investments align with statutory mandates. As a reminder, money transmitters licensed in Maryland are required to maintain a tangible net worth of at least $150,000 plus an additional $10,000 for each licensed branch location or authorized delegate, up to a statutory maximum of $500,000. Licensees must also ensure surety bond coverage remains accurate and appropriately adjusted based on their transmission activity. Additionally, you must maintain permissible investments sufficient to cover all outstanding transaction liabilities. Maryland's prudential requirements are intended to ensure companies maintain sufficient financial capacity to operate safely and protect consumers from loss. Simply put, if you are growing your business, your financials must grow with it. As your business activity evolves, ensure your growth strategies and operational changes continue to align with your financial responsibility obligations. And third, we expect strong corporate governance and enterprise risk management frameworks. As technology and operational models become more sophisticated, internal controls, escalation processes, compliance management systems, and board oversight become increasingly important. When innovation accelerates, weak governance structures are almost always the root cause of operational, compliance, and consumer protection failures. We are particularly focused on whether institutions are appropriately identifying, assessing, and managing operational, compliance, fraud, cybersecurity, and third-party risks. Relatedly, agent and authorized delegate oversight continues to be a significant area of supervisory attention. Licensees remain fully responsible for the activities conducted under their license, including those managed by authorized delegates. For example, Maryland law contains specific notice and disclosure requirements applicable to authorized delegates, and we continue to identify issues where required notices are incomplete or missing entirely. We expect companies to maintain effective oversight, monitoring, training, and controls to ensure ongoing compliance across their entire network. Looking ahead, OFR will begin examining registered virtual currency kiosk operators who also hold money transmitter licenses. These examinations will focus on compliance with both Maryland money transmission requirements and Maryland's virtual currency kiosk laws and regulations. As this space evolves, companies must ensure their compliance management systems and operational controls appropriately address these distinct legal obligations. In addition to our traditional examination work, OFR is actively working to better understand emerging technologies and evolving industry practices. As part of those efforts, we have officially incorporated questions relating to artificial intelligence into our money transmission examination workbook to better understand how companies utilize AI-related tools within their operations, compliance functions, or customer-facing activities. We are also preparing to roll out a stablecoin survey intended to help us gauge the scope and nature of stablecoin-related activity occurring within the Maryland marketplace. These efforts are part of a broader agency focus on modernization. Over the past year, OFR has expanded its focus on innovation and evolving financial services models. As many of you know, the agency formally established an assistant commissioner role dedicated to innovation and emerging risks. This reflects our broader recognition that as our industry rapidly evolves, our regulatory approach must remain informed, adaptable, risk-aware, and responsive. A major focus of mine has been listening and information gathering. To that end, we have met with industry participants, peer regulators, and internal staff to strengthen our approach to innovation, stakeholder engagement, and policy development. Much of the feedback we received reinforced our internal priorities while providing excellent opportunities to refine and operationalize our innovation and modernization strategy. To date, we have achieved 3 major milestones. First, we established a 3-year innovation roadmap to guide OFR's efforts. That work is focused on 3 main pillars: strategic leadership, stakeholder engagement, and regulatory and operational modernization. Second, we developed internal innovation guides on emerging topics to support examiner awareness and strengthen agency readiness. And lastly, we increased cross-agency coordination on emerging issues such as blockchain and digital assets, AI utilization, and evolving third-party service provider models. We still have significant work ahead, but we are excited about the direction of these efforts and look forward to continued engagement with all of you as this work progresses. Thank you all for your time today. If you have questions relating to innovation and emerging issues, please feel free to contact me directly. Questions relating specifically to MSB examinations may be directed to our Director of Money Services and Consumer Credit Supervision, Sabrina Brown. With that, I will turn it over to Michael Sprouse, Deputy Commissioner of Depository Supervision.
Good afternoon. My name is Michael Sprouse, and I am the Deputy Commissioner of Depository Supervision for the Office of Financial Regulation. I appreciate this opportunity to share depository updates from our office. Maryland's state-chartered financial system consists of 18 banks, 6 credit unions, and 4 non-depository trust companies serving communities from Western Maryland to the Eastern Shore. These institutions maintain deep ties to the communities they serve, supporting local businesses, families, and economic growth through long-standing relationships built over generations. Their local knowledge and community commitment remain an important foundation of Maryland's financial landscape. Maryland's state-chartered financial institutions performed well in 2025, demonstrated resilience despite economic headwinds, including rising unemployment, reductions in the federal workforce, and continued concerns in portions of the commercial real estate market. While the housing market showed signs of improvement, affordability challenges persisted, and elevated office vacancy rates remained an area of supervisory focus. Despite these challenges, Maryland's state-chartered financial institutions maintained positive financial performance and continued growth in assets, deposits, and loans while supporting the needs of their local communities. The strength of Maryland financial institution is reflected in their 2025 year-end performance metrics. However, it's important to note the acquisition of Sandy Spring Bank by Atlantic Union Bank in 2025 significantly impacted year-over-year totals, as Sandy Spring Bank was Maryland's largest state-chartered bank. While this transaction contributed to declines in year-over-year metrics, adjusted figures continue to reflect underlying growth and stability within Maryland's state-chartered financial system. The adjusted bank metrics removing the Sandy Spring Bank impact are as follows. Bank assets grew 1% to $35.2 billion. Bank loans grew 5% to $25.1 billion. Bank deposits grew 5% to $30.5 billion. Bank average ROA was 1.18%, which is a 39% increase compared to an average of 0.85 in 2024. Credit union assets grew 5% to $8.4 billion. Credit union loans grew 5% to $6.3 billion. Credit union deposits grew 3% to $7.1 billion. Credit union average ROA was 0.81, which is a 326% increase compared to an average of 0.19 in 2024. Non-depository trust company assets under management grew 18% to $506.2 billion. So let's move our discussion to depository challenges. As our financial institutions grow and have a positive impact on our communities, senior management teams must remain aware of risks that could undermine this success. In today's financial ecosystem, where the growth of technology is at lightning speed, AI use can be a game changer or a major concern. There's increasing fraud, elevated cybersecurity concerns, and developing and finding the expertise to manage all these concerns is certainly a major challenge. As we look at these challenges, I would like to focus on the following concepts: management board succession plans and cybersecurity. So let's discuss the first challenge. Succession planning is increasingly viewed by state and federal regulators as a critical safety and soundness responsibility rather than simply a human resources function. Effective succession planning supports operational resilience, strategic continuity, and sound risk management by ensuring institutions are prepared for leadership transitions. One of the more common weaknesses identified during examinations is the lack of a formal succession plan for the board of directors and senior management. Institutions that rely heavily on a small number of key individuals may face governance, operational, and strategic challenges when unexpected retirements, resignations, or other leadership changes occur. An effective board should maintain a diverse mix of skills and expertise, including areas such as credit, cybersecurity, technology, compliance, finance, audit, legal, and strategic planning. Likewise, institutions should identify and develop future leaders for key executive positions to ensure continuity of operations and oversight. Succession planning is not simply about replacing individuals. It is about maintaining institutional knowledge, leadership capacity, and effective governance. Institutions that proactively plan for leadership transitions are better positioned to manage risks, support long-term growth, and maintain safe and sound operations. Strong institutions proactively address these risks through a formal succession planning that supports both emergency leadership transitions and long-term organizational sustainability. A few highlighted best practices to support this initiative are as follows: identifying critical skill sets and evaluating future board and management needs, maintain a pipeline of qualified board candidates and future leaders, incorporating succession planning into strategic planning and enterprise risk management. From a supervisory perspective, institutions that proactively address succession planning demonstrate strong governance, sound risk management, and a commitment to long-term organizational stability. In today's evolving financial environment, effective succession planning is an essential component of a safe, sound, and well-governed institution. Now, let's discuss the cybersecurity challenge. Cybersecurity remains one of the highest supervisory priorities as the threat landscape continues to evolve. The rapid advancement of artificial intelligence is expected to significantly increase the speed, scale, and sophistication of cyber threats. AI-enabled phishing campaigns, deepfake impersonations, automated vulnerability discovery, credential attacks, and malware development have the potential to create new challenges for financial institutions and increase the importance of strong cyber resilience. As cyber threats become more targeted and automated, institutions should continue to strengthen cybersecurity controls, enhance incident response capabilities, and maintain a proactive approach to cyber risk management. In addition to direct cyber threats, financial institutions must remain focused on third and fourth-party risk management. Reliance on core processors, cloud service providers, fintech partners, and the other technology vendors continues to grow, increasing the potential for operational and cybersecurity risks originating outside the institution. Particular attention should be given to core service providers due to their critical role in supporting operations, payments, cybersecurity, and customer data protection. Effective vendor management programs should include ongoing due diligence, cybersecurity monitoring, business continuity planning, incident response coordination, and oversight of both third and fourth party relationships. To mitigate these escalating threats, institutions should continue strengthening foundational cyber hygiene practices and operational resiliency programs. A few key best practices include cybersecurity awareness training. Human error remains one of the leading causes of cyber incidents. Accelerated patch management. Institutions should expect an increase in vulnerability disclosures and patch volume as AI accelerates vulnerability discovery. End-of-life asset management, immutable and tested backups, strong authentication controls, and incident response and continuous monitoring. To strengthen cybersecurity resilience across Maryland's financial sector, the Office of Financial Regulation launched the Security Scorecard Initiative in December of 2024. This non-invasive monitoring program provides state-chartered institutions with monthly assessments of key internet-facing cybersecurity factors, including patch management, exposed credentials, endpoint security, malware activity, and dark web monitoring. The initiative delivers actionable intelligence that helps institutions identify vulnerabilities, improve cyber hygiene, and proactively mitigate risk. Since its launch, institutions have demonstrated measurable improvements in their cybersecurity posture. Today, 82% of participating institutions maintained an A security scorecard rating and 18% maintained a B rating, with no institutions rated in the C or D range. These results highlight the value of proactive monitoring, collaboration, and continuous improvement in strengthening cybersecurity across Maryland's financial system. Now, let's switch gears and talk about updates in the examination process. Federal banking regulators, including the FDIC, Federal Reserve, and the NCUA, continue to evolve supervision toward a more risk-focused and streamlined approach. This shift emphasizes reducing unnecessary burden, improving examination efficiency, and ensuring supervisory findings remain focused on material financial, operational, compliance, and safety and soundness risks. A key component of this evolution is the movement toward more concise reports of examination that provide meaningful value to institutions. Effective examination reports should focus on significant issues, root causes, and emerging risks rather than immaterial procedural matters. This allows both regulators and institutions to concentrate resources on areas that have the greatest impact on governance, cybersecurity, asset quality, capital, liquidity, compliance, operational resilience, and risk management. The Office of Financial Regulation supports this supervisory philosophy and continues to work closely with our federal regulatory partners as these changes are implemented. Our goal is to ensure examinations remain collaborative, effective, and appropriately tailored to an institution's size, complexity, and risk profile while maintaining strong safety and soundness oversight. This approach does not reduce supervisory expectations. Cybersecurity, asset quality, third-party risk management, succession planning, liquidity management, and governance remain key supervisory priorities. Rather, it ensures that examination findings appropriately reflect the significance and risk posed to the institution. OFR will strive to improve examination efficiency through enhanced communication, reduced report of examination turnaround times, and the use of technology and off-site monitoring tools. Initiatives such as the Security Scorecard program demonstrates our commitment to proactively identifying and mitigating risk before it becomes a larger supervisory concern. Our objective remains clear: to maintain a modern, risk-focused supervisory framework that protects consumers, supports safe and sound institutions, and provides meaningful value to Maryland state-chartered financial institutions. Our next topic is development in the payment innovation space. Governor Wes Moore signed the Maryland Stablecoin Act into law on May 12, 2026. The legislation establishes a framework for the regulation of stablecoin activities in Maryland and aligns the state's approach with the federal framework established under the Genius Act, which was signed into law in July of 2025. Importantly, the Genius Act created a state regulatory pathway for certain stablecoin activities. The Office of Financial Regulation strongly supported Maryland's participation in the development of the emerging payment innovation to help ensure consumers and businesses have access to safe, sound, and responsibly regulated financial technology solutions as the market evolves. The Maryland Stablecoin Act creates a pathway for non-depository entities to apply for a Maryland non-depository trust company charter with a certificate to issue stablecoins or provide stablecoin payment services. While state-chartered banks and credit unions must utilize the applicable federal approval process to directly issue stablecoins, the statute provides opportunities for these institutions to participate in stablecoin payment activities through affiliated entities. The legislation established a state pathway for stablecoin activities in Maryland by allowing new entities to apply for a Maryland non-depository trust charter and obtain a stablecoin certificate authorizing them to either issue stablecoins or engage in the business of providing stablecoin payment services. Additionally, the legislation provides opportunities for existing 19 Maryland state-chartered financial institutions to participate in the evolving digital payments ecosystem. State-chartered banks may establish a non-depository trust company subsidiary to provide stablecoin payment services, subject to obtaining a stablecoin certificate. Similarly, state-chartered credit unions may establish a credit union service organization to provide stablecoin payment services, also subject to obtaining a stablecoin certificate. The statute becomes effective on October 1st, 2026. In preparation, the Office of Financial Regulation is actively building the supervisory and operational framework necessary to support stablecoin activities in Maryland. Key implementation efforts include pursuing the federal certification process required for Maryland to serve as an approved state regulator, developing specialized examination expertise, and providing advanced training for supervisory staff. In addition, OFR will conduct an economic impact study to evaluate the competitiveness and long-term benefits of the charter structure to Maryland's economy. The agency also plans to issue industry guidance, regulatory notices, and other communications to ensure institutions have a clear understanding of regulatory expectations as the program is implemented. The Office of Financial Regulation recognizes the significant potential of stablecoin and payment innovation technologies when implemented in a safe, sound, and well-regulated manner. Our office remains committed to balancing responsible innovation with strong consumer protection, operational resilience, and financial oversight. Additional information and guidance will be provided to industry stakeholders in the weeks and the months ahead. Finally, let's discuss some exciting updates with the Access to Banking and the MCIV Fund initiative. The Office of Financial Regulation continued to advance the goals of the Access to Banking Act and the Maryland Community Investment Venture Fund during 2025 and 2026. For assessment year 2025, participating banks and credit unions earned $194,000 in assessment fee credits for operating 32 branches in low to moderate income communities, an increase from $165,000 in 2024. Institutions also contributed 21,000 of these credits to the MCIV Fund, which will be matched by OFR. The year also marked the first de novo LMI branch to qualify for a higher assessment fee credit. To expand access to capital and financial services, OFR partnered with the Governor's Innovation Team to conduct a nationwide search for fintech partners interested in working with Maryland state-chartered financial institutions. More than 160 fintech companies from 25 states expressed interest, resulting in 14 fintechs being selected to participate in the MCIV Connect event held in Baltimore in September of 2025. The event brought together representatives from 19 Maryland state-chartered banks and credit unions and served as a catalyst for new partnerships focused on serving LMI communities. These efforts resulted in the first two MCIV Fund Grant Awards. Following a competitive application and review process, OFR approved two $50,000 grants. The first awarded partnership includes First United Bank and Trust and Abrigo, which will deploy automated small business lending technology to expand lending opportunities in LMI communities. The second awarded partnership includes Harco Credit Union and Lone Star Technologies, which will provide merchant point-of-sale financing solutions to LMI businesses. On May 19, 2026, OFR and the Governor's Innovation Team hosted the Expanding Horizon Access to Capital Forum and formally announced the inaugural MCIV Fund grant recipients. The event also highlighted enhancements to the Access to Banking Act that become effective July 1, 2026. The enhanced law expands the MCIV Fund to support both consumers and small businesses in LMI and communities, increasing the potential impact of future partnerships. It also doubles the maximum grant award from $50,000 to $100,000. Additionally, the legislation establishes the Maryland Opportunity Account Program, a groundbreaking concept that aligns with the National Bank On program. State-chartered banks and credit unions that offer qualifying low-cost transaction accounts will be eligible for annual assessment fee credits, further supporting efforts to expand access to safe and affordable banking services. These initiatives reflect OFR's ongoing commitment to supporting Governor Moore's vision of expanding access to capital, banking services, and economic opportunity throughout Maryland's underserved communities. Thank you for the opportunity to provide depository updates from our office. Now I would like to turn it over to my esteemed colleague, Kat Hyland.
Hi, I'm Kat Hyland, the Deputy Commissioner of Financial Services and Consumer Protection. I oversee the non-depository activities at the Maryland Office of Financial Regulation. Thank you for joining us for this year's stakeholder webinar. Whether you're a licensee, a consumer advocate, an industry partner, or someone who works alongside us in another regulatory capacity, I'm glad you're here. This annual update is one of the ways we try to keep the lines of communication open, and we take that responsibility seriously. Each year, I try to step back and think about not just what we did, but why it matters and what it tells us about where we're going. So today's conversation isn't just a list of activities. It's a look at the work through the lens of the people it's meant to serve: Maryland consumers, responsible businesses, and the financial marketplace as a whole. I oversee 4 core units: enforcement, licensing, mortgage supervision, and our consumer response unit. I'll walk through highlights from each, then spend some time on a topic that cuts across all of them: how OFR is approaching and implementing artificial intelligence, and close with some thoughts on where we're headed. Over this past year, we've implemented a reorganization that brought our enforcement and consumer response units together under one Assistant Commissioner of Enforcement, Dana Allen. We've recently hired Anthony Walker as Director of Enforcement and Consumer Response. We've also appointed Assistant Commissioner Clifford Charlin to lead Financial Services, Licensing, and Supervision. And Meredith Merchant, a longtime member of our leadership team, continues to serve as Operations Director and Senior Advisor to the office. These changes position us well for the work ahead. Let me start with some context. The financial services landscape in Maryland and across the country is moving fast. In the past few years alone, we've seen the rapid expansion of earned wage access products, the growth of digital payment platforms, increasingly sophisticated fraud schemes targeting consumers of all ages, and ongoing questions about how existing regulatory frameworks apply to new business models. At OFR, our job is to keep pace and, when necessary, to get ahead of it. That means being thoughtful about how we use our existing tools, working collaboratively with industry and stakeholders, and being willing to evolve our approaches as the marketplace evolves. With that backdrop, let me turn to the work. I'll begin with enforcement. This fiscal year, our enforcement unit initiated 60 new investigations and closed 33 so far, with totals of restitutions and penalties pending. FY25 efforts resulted in $792,750 in penalties assessed and $4 million in total restitution ordered to harmed Maryland consumers. Those numbers reflect OFR's commitment to both accountability and proportionality, and to making sure that when we act, it actually puts money back in consumers' pockets. Not every compliance concern requires a formal action, and when informal resolution is appropriate, we pursue it. But when consumer harm is present or regulatory integrity is at stake, we act. Some of the most significant work this year involved multi-state actions, which I want to highlight because they illustrate what coordinated state regulation can accomplish. Maryland participated in the multi-state action involving mortgage loan originator misconduct by Patrick Donlin, a coordinated effort involving 22 states. We also participated in a landmark $20 million multi-state settlement with Bayview Asset Management and its subsidiaries following a cybersecurity examination that identified significant weaknesses in their programs. OFR led multi-state negotiating teams on that matter, and it resulted in the first ever multi-state settlement by state financial regulators focused on cybersecurity violations. OFR received nearly $575,000 in penalties and administrative fees as part of that settlement. We also joined regulators from 47 other states in an $80 million settlement with Block Inc., the parent company of Cash App, following the identification of serious deficiencies in its Bank Secrecy Act and anti-money laundering program. OFR's share of that penalty exceeded $1.64 million. These actions underscore something I believe deeply. State regulators are most effective when we work together. Complex financial actors don't stop at state lines, and neither does our oversight. Beyond multi-state work, our enforcement this year extended into unlicensed activity, credit services, and debt collection. A few actions are worth highlighting, and several remain underway. Bay Motors, Inc. and its owner operated a used car dealership and issued installment loans to Maryland consumers across 2021 and 2022 without holding a required license. OFR brought charges, and the case went to a full administrative hearing. The ALJ recommended a nominal penalty, but Commissioner Salazar increased it to $2,750 with a cease and desist order, reasoning that any penalty for unlicensed activity must, at minimum, exceed what the respondent would have paid in licensing fees, and that to do otherwise creates an incentive to violate Maryland law. This case is a good illustration of how OFR thinks about the purpose of licensing requirements not as a bureaucratic hurdle, but as the mechanism through which the public is protected from unqualified or unscrupulous actors. We also issued a summary cease and desist order against Apex Land Holdings LLC and its related parties for unlicensed financial services activity targeting Maryland consumers. That matter is currently underway, and we expect it to be resolved in the coming year. 3 additional enforcement actions were filed in the period covered by this report. OFR issued cease and desist orders for unlicensed lending and debt collection. These matters are proceeding through the administrative process. I also want to flag a matter that speaks to an important topic in consumer finance law: tribal lending. OFR's enforcement action against American Web Loan, a tribal lending entity that made unlicensed loans to Maryland consumers, is currently on appeal before the Maryland Appellate Court. The company has asserted tribal sovereign immunity as a defense. Our position is clear. Tribal affiliation does not exempt a lender from Maryland's consumer protection laws when the borrower is a Maryland resident and the loan was made here. This case has implications beyond Maryland, and we are watching it closely, as are regulators across the country who are grappling with the same question. A major focus this year has also been the continued implementation and oversight of Maryland's Earned Wage Access Law, House Bill 1294. Our work this year involved direct engagement with EWA providers, review of licensing considerations, and ongoing regulatory development to ensure that the framework Maryland enacted is working as intended. We've been focused on transparency, making sure consumers understand costs, repayment structures, and accountability. We will continue monitoring this space closely as products evolve and market practices mature. Finally, I want to be direct about something that cuts across everything we do in enforcement: fraud. As schemes become more sophisticated, our response must be equally agile. Effective regulation in this environment requires more than just authority. It requires a team of highly trained professionals who can spot emerging risks and dismantle complex misconduct. That is why we continue to prioritize the professional development of our investigators and examiners. A key part of that investment is the Certified Fraud Examiner, or CFE, designation. This globally recognized credential from the Association of Certified Fraud Examiners provides specialized expertise in everything from detection and deterrence to the specific legal elements of financial crimes. It's about giving our staff the advanced investigative techniques they need to stay ahead of bad actors. I'm proud to share that during fiscal year 26, 4 of our enforcement investigators successfully earned their CFE designation. This isn't just a professional milestone for them, it's a win for Maryland. It strengthens OFR's collective capacity to identify fraudulent activity and evaluate how well institutions are protecting themselves. By expanding our institutional expertise in fraud risk management, we are better equipped to safeguard the integrity of the marketplace and protect consumers who depend on it. We now have 8 certified fraud examiners at OFR throughout the non-depository units and active board members in the Maryland chapter of the Association of Certified Fraud Examiners. Social engineering scams, impersonation scams, and digital finance fraud are causing real harm to Maryland consumers, and increasingly to consumers who are not the typical picture of a vulnerable person. They are sophisticated schemes targeting professionals, seniors, young adults, small business owners alike. No demographic is immune. Enforcement after the fact matters, but it isn't enough. Prevention requires education and partnership. That is why we have increasingly integrated consumer outreach and interagency coordination into our enforcement strategy, not just to respond to harm, but to try to get upstream of it. This year, the enforcement unit fully implemented Everlaw, a cloud-based e-discovery and litigation platform that uses AI to help our attorneys and investigators find relevant information and build cases more efficiently. It's a concrete example of how technology can make experienced staff more effective without replacing their judgment. The team also started using NotebookLM and Gemini. Turning to licensing. If enforcement is about accountability, licensing is about access. And this year, improving that access has been a top priority. For many businesses, licensing is the primary point of contact with OFR. It's often the first impression. And frankly, first impressions matter. If the licensing process is confusing, slow, or opaque, it signals something about how the agency works. We want it to signal efficiency, transparency, and responsiveness. This year, we issued 17,545 active licenses, a 6.7 increase over the prior year, driven largely by growth in the mortgage loan originator licenses as the market stabilized after several years of contraction. We processed 695 new company applications with an average processing time of 50 days and 3,962 mortgage loan originator applications with an active processing time of 16 days. We continued efforts to reduce backlogs and modernize internal workflows, particularly through our use of NMLS, the nationwide multi-state licensing system, and broader technological improvements. I was also elected District 1 representative to the NMLS Policy Committee, where I proudly represent the region at monthly meetings. One significant milestone this year was OFR exercising its assessment authority for the first time. Under legislation enacted in 2023, the office gained the ability to impose annual assessments on our licensees to ensure stable, sustainable funding for our oversight work. This year, we assessed nearly $6 million, and more than 96% of that total was paid by the due date. That level of compliance reflects both the clarity of the process and the professionalism of the industry we regulate. Last year, House Bill 1516 created a licensing exemption for passive mortgage trusts. It also required OFR to chair and staff the Maryland Licensing Work Group, creating an ongoing structure for dialogue on licensing modernization. That work group, which includes OFR, regulated entities, industry representatives, and consumer advocates, is now focused on broader licensing modernization, including application workflows, renewal processes, and how technology can better serve both businesses and the public. I want to be candid. These conversations aren't always easy. Modernization requires change, and change requires agreement on what we're trying to achieve. But the dialogue has been productive, and I believe the work group is generating real value. We anticipate bringing the work group's proposals forward in the coming years, and will continue engaging stakeholders as that work develops. On the financial services supervision side, our teams oversee a wide and growing range of institutions and licensees, and this year has required us to think carefully about how we do that work as effectively as possible with the resources we have. We completed 357 examinations this year, covering mortgage lenders, servicers, and brokers, as well as money transmitters and other non-depository financial services providers. Of those, 303 were mortgage examinations, resulting in $128,453 in refunds and restitution to approximately 79 consumers, and 54 were money transmitter examinations, split between full scope reviews and desk reviews. Our mortgage supervision team has been focused on accepting all or portions of other states' examinations when possible, allowing us to examine more licensed companies while reducing regulatory burden. While we've had authority to do this in our money transmitter examination program, the authority to do it with mortgage examinations is the result of a recent amendment to regulation. Our examination work is fundamentally about understanding what's happening inside regulated entities, not just whether they're technically in compliance, but whether their practices are consistent with both the letter and spirit of Maryland law. Like many state regulators, we face resource constraints even as our licensee population and the complexity of the products they offer continue to grow. This year, we expanded our use of risk-based supervision and desk reviews as a complement to full examinations, not as a retreat from rigorous oversight, but as a more strategic approach to it that concentrates our in-person examination capacity where risk is highest. Cybersecurity has also been a major priority this year, and I expect it to remain one for the foreseeable future. This year, we took meaningful steps to expand our capabilities on the non-depository side. OFR currently uses Security Scorecard to monitor the external cybersecurity posture of non-depository licensees, and we are actively developing a structured implementation plan to make full use of that capability across our supervised population. Our goal is a framework similar to what our depository colleagues have built, proactive, collaborative monitoring that provides licensees with regular reporting on their cybersecurity posture and helps them identify and address vulnerabilities before they become crises. The emphasis is on partnership, not punitive oversight after something has already gone wrong. We also expanded our capabilities this year in an area where financial crime is increasingly concentrated: cryptocurrency. Through OFR's membership with MAGLISEN, the Mid-Atlantic Great Lakes Organized Crime Law Enforcement Network, OFR now has access to 2 Chainalysis tools for cryptocurrency tracing and investigation. The first, Chainalysis Reactor, allows investigators to trace the flow of funds across blockchain transactions and map connections between wallets and entities. The second, Chainalysis Rapid, is an AI-powered triage tool designed to quickly assess whether a cryptocurrency transaction warrants further investigation, and it requires no prior crypto experience to use. Together, these tools meaningfully strengthen our ability to follow the money in cases involving digital assets, which increasingly intersect with the unlicensed lending, fraud, and money transmission violations that are core to our enforcement mission. We've also continued investing in examiner training and examination modernization. Training this year included a 3-day virtual session on responsible AI in the mortgage industry, sponsored by the American Association of Residential Mortgage Regulators. Consistent, well-trained examiners are the foundation of effective supervision, and that investment pays dividends. Before I close, I want to turn to a unit that touches every part of our work and that I think deserves more visibility than it typically gets. Our Consumer Services Unit is now known as the Consumer Response Unit, or CREW. So far this fiscal year, CREW has closed 962 consumer complaints and recovered $548,184 for Maryland consumers. Complaints came from across the state and spanned a wide range of issues: mortgage servicing concerns, debt collection practices, scams and impersonation fraud, payment disputes, and general consumer finance questions. Every complaint tells a story, and often it tells us something we couldn't learn any other way. When a consumer contacts OFR, they're often not just frustrated. They may be afraid. They may have lost money they couldn't afford to lose. They may not understand what happened to them or what their options are. One of the most important things CREW does is meet people where they are, help them understand their rights, navigate the complaint process, and connect them with the appropriate regulatory response. To give you a sense of what that looks like in practice, a consumer contacted us after their money transfer account continued to be drained by fraud, even after they'd reported the problem to the payment company. Our intervention recovered over $93,000 for that consumer. In another case, a consumer whose check from a local bank was lost in the mail after closing a CD account recovered over $106,000, including interest, through OFR's complaint process. These are real dollars for real people, and that's what this unit is for. But CREW's value goes beyond individual complaint resolution. Complaint data is one of our most important early warning systems. When we see a spike in complaints about a particular company, a particular practice, or a type of product, that gets our attention. It may lead to a supervisory referral, an examination, or an enforcement inquiry. This year, 54 complaint investigations were referred to our enforcement unit for further action, meaning that what started as a consumer concern became a regulatory matter with broader implications. We've also strengthened coordination between CREW and the enforcement unit to improve information sharing and ensure that issues identified at the consumer level can be evaluated more quickly for broader regulatory implications. That integration is still maturing, but the early results are promising. For any consumers watching this webinar, OFR is here for you. If you have a complaint about a financial product or service, whether it's a mortgage, debt collector, check casher, student loan servicer, or any other licensed financial business, we want to hear from you. Our website has resources and complaint submission options, and our CREW staff are here to help. I want to take a few minutes to talk about artificial intelligence, because it's a topic that's on everyone's minds right now, and I think it's important for OFR to be transparent about where we are and how we're thinking about it. Let me be direct about our starting point. OFR is not a technology agency. We are a regulatory agency, and that distinction matters when it comes to AI. Our interest in these tools is not novelty, it's capacity. How do we do our jobs better, faster, and more consistently with the resources we have? AI is one answer to that question, but it requires a disciplined approach. This year, OFR launched a structured rollout of Gemini, Google's AI platform, to staff across the office. This was not a decision made lightly or quickly. Before any staff member received access to Gemini, we developed a training program designed to ensure that people understood not just how to use the tool, but how to use it responsibly and where not to use it at all. As of today's date, 75 OFR staff have completed our AI training and received access to the platform. That training covers the fundamentals of how large language models work, their known limitations, including the tendency to generate plausible sounding but incorrect information, and the specific guardrails that govern how staff may use these tools in their work. Currently, staff are using Gemini primarily for drafting, summarizing, and research assistance for things like routine correspondence, summarizing lengthy documents, preparing background research on regulatory topics, and accelerating writing-intensive work that doesn't require a lawyer's judgment at every step. One area where we use AI is in processing our weekly reports as an automated process. Now, a task that used to take 2 hours takes 20 minutes. The goal is to free up staff time for the work that genuinely requires it. Now, I want to be clear about what we are not doing, because I think that's just as important. We are not using AI to make regulatory decisions. We are not using it to analyze confidential examination findings or licensee data. We are not using it as a substitute for legal judgment in enforcement matters. And we are not treating AI output as reliable without human review. Every use of these tools at OFR is subject to staff verification and professional accountability. The tool assists, a person decides. We are also actively exploring whether and how AI tools can be responsibly deployed in more sensitive supervisory contexts. including work that touches confidential regulatory information. That exploration is proceeding carefully with legal review, security frameworks, and governance structures being developed in parallel. We are not moving faster than our controls allow, but we believe this is a frontier worth pursuing because the potential to make supervision more consistent, more efficient, and more risk-sensitive is real. This governance-first approach reflects something I care about deeply. The public trust that OFR depends on is built on reliability, accountability, and transparency. AI tools used carelessly can undermine all three. Used thoughtfully, with clear rules and meaningful oversight, they can make us more effective without compromising the integrity of our work. We are also watching closely how AI is reshaping the industries we regulate. This past year, OFR conducted a statewide survey of Maryland financial institutions to understand how they are adopting AI in their operations. The results are shaping our thinking about how to foster responsible innovation and service delivery while ensuring appropriate consumer safeguards. Financial services providers are using AI for underwriting, fraud detection, customer service, and marketing, and those uses raise real questions about fairness, transparency, and consumer protection that regulators will need to address. OFR is engaged in those conversations at the state and multi-state level, and we expect AI-related regulatory questions to be a growing part of our work in the years ahead. As I look ahead to the coming year, a few themes stand out. First, modernization. I've spoken about our AI implementation in some detail today, and I want to return to it briefly here because it exemplifies the kind of modernization I think is most valuable. Not technology for its own sake, but technology that makes government work better for the people it serves. We will continue expanding our AI capabilities thoughtfully, with governance and training keeping pace with deployment. And we will continue watching how these tools reshape the industries we regulate, which will require us to stay nimble as a regulatory body as well. Second, collaboration. The most effective regulation, and I believe this deeply after years in this work, happens through partnership. With industry, with consumer advocates, with other regulators, with the communities we serve. OFR doesn't have a monopoly on good ideas, and we're better at our jobs when we stay in genuine dialogue. Third, balance. Maryland should be a state where responsible innovation can succeed, where new products can be brought to the market by companies that play by the rules, and where consumers know that if something goes wrong, there is a regulator paying attention and willing to act. That balance is not always easy to achieve, but it is what we are working toward every day. Finally, I'll say something that I mean sincerely. The work we do at OFR matters because the people it affects are real. Real families navigating mortgage servicers who aren't responding to their calls. Real workers trying to understand whether a payroll product is costing them money they don't realize they are spending. Real consumers who have been defrauded and don't know where to turn. That's who we work for. And that's who I have in mind as we head into the year ahead. Thank you for taking the time to watch this update. I'm grateful for the partnerships that make this work possible, with industry stakeholders who engage in good faith, with consumer advocates who hold us accountable, with colleagues across state and federal agencies, and with the Maryland Department of Labor. If you have questions about anything I've covered today, or if there are topics you'd like to see us address in future communications, please don't hesitate to reach out. I look forward to continuing this work together. And now I will turn it over to Toni White, Director of Outreach and Education, for closing remarks.
Thank you to all of our guest speakers for joining us today and for sharing valuable insight into the important work being done at the Office of Financial Regulation. We also appreciate the continued dedication of our staff and partners as we work to address the opportunities and challenges ahead in serving Maryland consumers, businesses, and communities. This concludes today's presentation. As a reminder, if you submitted a question that was not addressed during the webinar, a member of our team will follow up with you directly. Commissioner Salazar, would you like to share any final remarks with participants?
Thanks, Toni. I do want to thank all our participants for being here today. I hope you saw that we had a very impactful year in 2026. We're looking forward to an equally productive and exciting year for 2027. Finally, I want to thank everyone here at OFR who's had a hand in putting this webinar together. It's projects like these that show the best of our office. Back to you, Toni.
Thank you again to our speakers, staff, and everyone who joined us today. We appreciate the opportunity to serve Marylanders and look forward to continued collaboration and future discussions. Have a wonderful day, everyone.